A holding company structure is one of the most powerful tools for protecting assets and optimizing business operations. But what exactly is a holding company, and how can it benefit your business? A holding company is an entity that exists primarily to own valuable assets rather than conduct day-to-day business operations. These assets can include stocks in other companies, real estate, intellectual property like patents and trademarks, and even private equity funds. Consider this structure like a parent-child relationship. The holding company serves as the parent that owns and controls its subsidiaries, which are the operating businesses that generate revenue through products or services. There are several types of holding companies to consider based on your business needs. A pure holding company exists solely to own shares in other companies without conducting any operations itself. A mixed holding company both owns shares and conducts some operational activities. An immediate holding company directly owns the majority of another company's shares, while an intermediate holding company sits between the parent and operating subsidiary. Finally, a personal holding company is formed by individuals specifically to reduce personal tax liability. One of the primary benefits of a holding company structure is risk management. By separating assets from operations, you create what business professionals call silos that isolate potential liabilities. If one subsidiary faces legal troubles or bankruptcy, the other assets owned by the holding company remain protected. Take this example. You create Blue Ocean Holding Company and raise $10 million. You use this capital to establish multiple businesses, including a Dairy Queen franchise and a hotel operation. If the hotel business fails, only the capital invested in that specific subsidiary is at risk. Your Dairy Queen franchise and other investments remain safe from creditors. This protection works because each subsidiary operates as its own legal entity. The parent holding company owns these subsidiaries, but maintains legal separation from their operations and liabilities. Beyond risk management, holding companies offer significant tax advantages. For limited liability companies using pass-through taxation, profits and losses flow directly to individual members, avoiding corporate-level taxation. For C corporations, a holding company that owns at least 80% of a subsidiary can receive dividends without paying additional corporate taxes on those distributions. A well-structured holding company also simplifies asset management. Valuable intellectual property, real estate, and equipment can be owned by the holding company and leased to operating subsidiaries. This arrangement not only protects these assets, but can create tax-efficient income streams through internal leasing arrangements. Consider a manufacturing business using this model. The parent holding company owns separate subsidiaries for intellectual property, real estate, equipment, human resources, and manufacturing operations. The manufacturing subsidiary pays fees to the other entities for the use of their assets and services, creating a structure that both protects assets and optimizes taxation. Holding companies are particularly useful in several business scenarios. They work well for franchise ownership, where each location operates under its own LLC while the holding company retains control of the intellectual property. Real estate investors use holding companies to own properties through individual LLCs, limiting liability while maintaining centralized management. Family-owned businesses benefit from holding structures that facilitate succession planning and estate management. However, maintaining a holding company structure requires careful attention to governance and compliance. Each entity must have separate operating agreements, bank accounts, and records. Regular meetings should be documented, and formal agreements should govern all transactions between entities. Failing to maintain proper separation between entities risks piercing the corporate veil, which could expose the holding company to the liabilities of its subsidiaries. This means the holding company should never engage in operating activities like selling products or services, which should be handled exclusively by the operating companies. The costs and benefits of a holding company structure must be carefully weighed. While the structure offers enhanced asset protection, simplified succession planning, and improved financing options, it also creates additional administrative burdens, more complex tax filings, and potential intercompany disputes. For businesses with valuable assets to protect or multiple operations to manage, a holding company structure provides a powerful framework for growth and risk management. With proper legal and tax planning, this structure can help safeguard your business assets while creating opportunities for expansion and optimization.